Welcome back to the Daily Crypto Roundup. Today's episode is firmly back in news mode. Over the last day, crypto markets have continued to respond to a familiar mix of macro pressure, shifting risk sentiment, and selective institutional developments. Rather than focusing on price swings alone, today we're going to walk through the actual stories shaping the market right now. The developments that explain why crypto is behaving the way it is. There isn't one single headline driving everything today. Instead, we're seeing a combination of macro-led selling pressure in large caps, pockets of retail interest in smaller opportunities, new institutional filings, and ongoing debate about how crypto fits into the broader financial system. Taken together, these stories paint a clear picture of a market that's cautious, reactive to macro signals, and increasingly shaped by institutional frameworks rather than pure speculation. We'll go through each of today's headlines in turn, let them stand on their own, and then toward the end, we'll step back and connect the dots. Now let's ground everything in reality with actual market prices. As of right now, Bitcoin is trading around $88,520, having pulled back slightly in today's session but holding above key intraday support. Ethereum is trading near $2,958, continuing to track Bitcoin's range-bound action. XRP is around $1.90, BNB is near $880, and Solana is trading around $126.58, all reflecting a cautious market tone. Smaller caps are similarly subdued, with Cardano around 35 cents and Dogecoin near 12 cents. Across the broader market, total crypto capitalization sits just under roughly $3 trillion, and Bitcoin's dominance remains around 59%. Showing that capital is still concentrated in the largest assets. From a sentiment perspective, the Crypto Fear and Greed Index continues to signal fear, though it no longer deteriorates, suggesting that recent selling pressure may be stabilizing rather than accelerating. Now let's move into the headlines. The first story today is renewed selling pressure in Bitcoin and Litecoin, aligned closely with broader macro headwinds and risk-off conditions. Bitcoin and Litecoin both saw weakness today as global markets continued to digest geopolitical and macroeconomic uncertainty. This isn't isolated to crypto. Equity markets, commodities, and currencies have all shown signs of caution as investors reassess exposure to risk assets. In that environment, Bitcoin and Litecoin, which both trade as liquid, easily adjustable positions, are often among the first assets to be trimmed. What's important here is the nature of the selling. This does not appear to be panic-driven retail capitulation. Instead, it lines up with portfolio-level adjustments being made as macro risk remains elevated. Bitcoin and Litecoin are widely held, highly liquid, and easy to scale in and out of. That makes them natural candidates for short-term de-risking when uncertainty rises. Litecoin's inclusion in this move is notable because it often behaves as a proxy for broader market sentiment. When Litecoin weakens alongside Bitcoin, it usually reflects a general risk-off posture rather than coin-specific news. That's what we're seeing today. This kind of selling pressure reinforces the idea that crypto is still very much connected to global risk conditions. While longer-term narratives around digital scarcity and decentralization remain intact, short-term price action continues to respond to the same forces driving other risk assets. The second story today shifts focus away from large caps and into a very different corner of the market, the APEMARS presale. Despite a generally weak market backdrop, the APEMARS presale has drawn attention as a standout performer. While Bitcoin and other large cap assets have been under pressure, this presale has seen strong retail interest driven largely by momentum, marketing, and speculative appetite. This is a familiar pattern in crypto. When large caps stagnate or pull back, some retail traders look for opportunities elsewhere, particularly in pre-sales and early-stage projects that offer the potential for outsized returns. APEMARS appears to be benefiting from that dynamic. It's important to frame this correctly. Pre-sale performance doesn't signal a broad market shift. It doesn't mean risk appetite has returned across the board. What it does show is that retail speculation hasn't disappeared. Even in cautious markets, pockets of high-risk, high-reward activity continue to attract attention. Historically, pre-sale interest often increases during periods of consolidation in larger assets. Traders who feel priced out of Bitcoin or frustrated by sideways action, sometimes rotate into smaller, more speculative plays. That doesn't make those plays safer, but it does explain the attention they receive. The APEMARS story is a reminder that crypto markets are not monolithic. Different segments respond differently to the same macro environment. The third story today brings us back to the institutional side of the market. ARK Invest filing for CoinDesk 20 crypto index ETFs. Cathie Wood's ARK Invest has filed with regulators to launch exchange-traded funds tied to the CoinDesk 20 index. This is a significant development because it represents an attempt to give investors broad exposure to the crypto market beyond just Bitcoin and Ethereum. The CoinDesk 20 index tracks a basket of major cryptocurrencies, offering diversified exposure across multiple networks. By filing for ETFs linked to this index, ARK is signaling interest in a more holistic approach to crypto investing, one that goes beyond single asset products. This matters for a few reasons. First, it reflects continued institutional engagement with crypto as an asset class, even during periods of volatility. ETF filings are not quick or casual decisions. They require legal work, regulatory engagement, and long-term planning. Firms don't file for new products if they believe an asset class is in terminal decline. Secondly, it suggests growing demand for diversified crypto exposure. As the market matures, some investors are less interested in picking individual tokens and more interested in gaining exposure to the sector as a whole. Index-based products meet that need. Third, it reinforces the idea that crypto is increasingly being treated like other asset classes, with benchmarks, indices, and portfolio construction frameworks. That's a long way from the early days of single-coin speculation. The ARK filing doesn't guarantee approval, and it doesn't change market conditions overnight. But it adds to the growing stack of institutional infrastructure being built around crypto. The fourth story today ties directly into market mechanics. Crypto ETF outflows are continuing, but with reduced intensity. Crypto ETFs are still seeing net outflows today. That's an important fact, and it shouldn't be ignored. However, the pace of those outflows has slowed compared to earlier sessions. This suggests that the most aggressive phase of de-risking may have already passed. ETF flows often reflect short-term positioning rather than long-term conviction. During volatile periods, funds rebalance, hedge, and reduce exposure to manage risk. Once that initial adjustment is complete, flows often stabilize, even if they remain negative. The reduced intensity of outflows today supports the idea that markets are moving from reaction into digestion. Investors have responded to macro risk, adjusted portfolios, and are now waiting for further signals before making additional moves. This aligns with what we're seeing in price action as well. Instead of cascading declines, prices are consolidating. That combination, slower ETF outflows and sideways price action, is typical of a market that's pausing rather than collapsing. The fifth story today is broader, but critical. Macro risk remains the dominant driver of crypto price behavior. Crypto markets continue to move in response to global macro and geopolitical headlines. Interest rate expectations, trade tensions, and political uncertainty are all influencing risk sentiment. When macro conditions tighten, crypto feels it. When uncertainty eases, crypto often stabilizes. This isn't a new dynamic, but it's an important one to acknowledge. Crypto has matured into an asset class that is deeply intertwined with global finance. It no longer trades purely on internal narratives. It responds to the same forces that drive equities, bonds, and commodities. Today's price action reflects that reality. There hasn't been a major crypto-specific shock. Instead, markets are reacting to broader uncertainty. That reinforces the idea that understanding macro context is essential for understanding crypto markets. The sixth and final story today shifts back to Ethereum and long-term structure. Vitalik Buterin's commentary on institutional decentralization. Vitalik Buterin has shared fresh thoughts on how Ethereum can accommodate institutional adoption without sacrificing decentralization. His commentary focuses on the idea that institutions don't necessarily have to centralize networks, but they do influence how networks evolve. This is an important conversation for Ethereum in particular. As more institutions interact with Ethereum through ETFs, custody services, and on-chain products, questions around governance, decentralization, and neutrality become more pressing. Buterin's perspective suggests that decentralization is not a fixed state, but a spectrum. The challenge is managing institutional participation in a way that preserves the core principles of the network while allowing it to scale and integrate with existing financial systems. This conversation matters because it goes beyond price. It speaks to the long-term identity of Ethereum and how it balances openness with adoption. As institutional interest grows, these questions will only become more important. Now let's step back and connect these stories. Today's headlines tell a coherent story about the state of crypto. Large-cap assets like Bitcoin and Litecoin are under pressure as macro risk remains elevated. At the same time, retail interest continues to find outlets in presales like APEMARS. Institutional engagement hasn't disappeared. It's evolving, as seen in ARK's ETF filing and continued infrastructure development. ETF outflows suggest caution, but the slowing pace indicates adjustment rather than exit. Macro conditions continue to dominate short-term behavior, and longer-term conversations about decentralization and institutional participation are shaping the future of networks like Ethereum. This is a market in transition, not euphoric, not broken, but cautious, reactive, and increasingly complex. That's it for today's Daily Crypto Roundup. Drop your thoughts in the comments. Let us know which of these stories you want us to dig into next, and make sure you're entered into the XRP giveaway. Thanks for listening, and, as always, we'll see you at the top.